I'll do a quick update on gold this morning. Yesterday, gold was very close to breaking out of what it looks like at this point anyway, a triangle consolidation pattern. These are usually continuation patterns. So if this does turn out to be a triangle, then at some point we should expect it to break out to the upside. And then this trend that has been in place since August will continue. Um, I I think the odds are probably a little bit um, better in favor of this rather than the handle of this cup and handle pattern continuing with a move below this low. But we'll see. Right now, there's no indication either way. Gold is just stuck in the middle of this pattern. If gold comes down and breaks below Thursday's low, then the triangle pattern will probably morph into a more um, discernible handle pattern, and then maybe we need to look at it more as something like this, where maybe uh, gold comes down, completes a failed daily cycle, comes down somewhere in this area, and that's where our handle or the handle part of this cup and handle pattern um, finally finishes, and then we start the next phase of the gold bull market. So let me put some Fibonacci retracements on here. We can maybe get an idea of where if this does morph into just a deeper handle, then maybe we get an idea of where we would want to maybe try again. Okay, so you can see this first leg down retraced to the 38% level. If this continues and we break below this daily cycle low here, then I would look for the handle to reach completion somewhere around this 50% retracement zone. And then at that point, I think the metals would be set up to finally break out of this um, multi-year basing pattern that they've been in. And let me see if I can't widen this chart a little bit. All right, so here was the bottom of the bear market, the baby bull rally, and then gold just got stuck in this difficult, volatile back and forth basing pattern. Um, you know, uh, we've got the cup part of the pattern intact. We're now working on the handle. Can either play out as a triangle consolidation, or like I said, if gold continues down and breaks below this daily cycle low right here, then we would have a failed daily cycle and just a deeper retracement on the handle. But either way, I think we are setting up in 2019 to finally break out of this basing pattern that gold has been stuck in, with a high here right around the 1360 to 1370 zone. So I think 2019 is going to be the year we break out of this. So big potential building uh, in this sector, but we've got to finish this corrective part of the cup and handle pattern first. And right now it's just too early to tell whether this is going to play out as a triangle or as a deeper pullback, maybe to that 50% Fibonacci retracement. And looking at the miners, we've kind of got the same dilemma. As of today anyway, this looks like a triangle consolidation in progress, but it's just too early to tell whether this will um, hang on to this triangle pattern and eventually break out to the upside, or whether um, price breaks down from here and we get a deeper correction, maybe something that comes down and fills this gap here. I'm sure the hedge funds are still gunning for this gap. So again, just we're stuck in the middle of this consolidation, and it's too early to tell whether or not the triangle pattern is going to hold, or whether it morphs into something else with a deeper pullback. And and we need to wait a little longer. But either way, this is where the potential is building, in my opinion, not 15 weeks into the stock market cycle or 15 weeks into the energy markets. Um, those trends are getting very mature. Sentiment is very extreme in both of those markets now. Um, and you're just at risk. Realistically, you're at risk of some kind of mini crash. The longer a cycle translates, the more risk there is of a crash event. The reason being is, um, and let me move over to the S&P so I can maybe explain this a little better. Okay, so you can see we can use this as a perfect example. This intermediate cycle, right translated to an extreme, um, got very, very late in the intermediate cycle. Sentiment got extremely complacent, and then what happens is the entire intermediate correction has to run its course very quickly because the cycle has run out of time. So there isn't a lot of time left for the correction to run its course. So what happens is you get one of these mini crashes. Kind of the same thing here, just market right translated, 4 daily cycles, um, and then we get this crash event down into the bottom, and then for whatever reason we get a 5th daily cycle with another crash to our final, what I think is a 4-year cycle low. But we're kind of running into the same problem here, where the cycle is right translating to an extreme degree. We're 15 weeks into this intermediate cycle with no sign of an intermediate degree correction. I suspect the central banks, the Fed in particular, is going to try and keep this market propped up into the May FOMC meeting. And they don't do anybody any favors by doing this, because it just creates massive complacency. And that's what triggers these kind of crash events at the very tail end of an intermediate cycle. So, um, uh, keeping the market propped up is just not going to do anybody any favors. It's going to get people caught in another semi-crash type event. Again, I don't think we're going to test these lows, but if they keep this up and build more and more complacency in the market, the risk is certainly there that um, we could come back down and test 2,600 and do it very quickly in a very short period of time. So, even as short as 5 to 10 days. So risk is building in this market that just keeps stretching and stretching, becoming more and more complacent, whereas potential is building in the metals market, which has been correcting now for about 6 weeks, I believe. Switch back over to gold here. I guess actually it's been about 7 weeks. So this market has been in correction mode for 7 weeks, whereas the stock market is 15 weeks into a rally, and our emotions tell us that the stock market is going to be bulletproof and can never come back down, and that gold is in trouble and can never go back up. But that's, emotions are what kill people in this business. This market that is correcting is building potential. The stock market that hasn't corrected is building risk. So the potential is in this market. We just need to see whether or not this triangle pattern holds, or if we break below this last Thursday's low, then then I would look for a bottom, maybe down around that 50% Fibonacci retracement, which is going to be somewhere down here close to 1260. So over the next few days, we should probably know whether which scenario is going to play out.